Chapter 9, Fundamental Legal Principles. This is for Principles of Risk Management and Insurance for third-year students, and this is Marwa Jalal, Assistant Lecturer at Cairo University, Faculty of Commerce, English section. Chapter outline. In this chapter we will cover the following points. Number 1, Principle of Indemnity. Number 2, Principle of Insurable Interest. Number 3, Principle of Subrogation. Number 4, Principle of Utmost Good Faith. And 5, Comparison between the different principles. Number 6, finally, with different MCQ questions. Number 1, Principle of Indemnity. Definition. The principle of indemnity states that the insurer agrees to pay no more than the actual amount of loss. In other words, the insured should not profit from the insurance. Most property and casualty insurance contracts are contracts of indemnity. If a covered loss occurs, the insured shouldn't pay more than the actual amount of the loss. A contract of indemnity does not mean that all covered losses are always paid in full because of deductibles or limits on the amount paid. The principle of indemnity has two main fundamental purposes. The first purpose is to prevent the insured from profiting from a loss. The second purpose is to reduce moral hazard, which means if dishonest policyholders could profit from a loss, they might cause losses with the intention of collecting the insurance. If the loss payments does not exceed the actual amount of the loss, the temptation to be dishonest is reduced, and it is applicable for most property and casualty insurance contracts, and they are contracts of indemnity. It is not applicable to life insurance contracts, because a life insurance contract is not a contract of indemnity, but is a valid policy that pays a stated amount to the beneficiary upon the insured death. The indemnity principle is difficult to apply to life insurance because it is meaningless in determining the value of a human life. Moreover, to plan for personal and business purposes, such as the need to provide a specific amount of monthly income to the dependents, a certain amount of life insurance must be purchased before this occurs. For these reasons, a life insurance policy is an exception to the principle of indemnity. Number 2, Principle of Insurable Interest. The principle of insurable interest states that the insured must be in a position to lose financially if a covered loss occurs. For example, if you have an insurable interest in your car because you may lose financially if the car is damaged or is stolen. You have an insurable interest in your personal property, such as a computer, books, and clothes, because you may lose financially if the property is damaged or destroyed. The purposes of an insurable interest. All insurance contracts must be supported by an insurable interest, either property or casualty insurance contracts or life insurance contracts. Insurance contracts must be supported by an insurable interest for the following reasons. Number 1, to prevent gambling. Because if an insurable interest were not required, the contract would be a gambling contract and would be against the public interest. For example, you could insure the property of another and hope for a loss to occur. Similarly, you could insure the life of another person and hope for an early death. These contracts would be gambling contracts and would be against the public interest. Purpose number 2, an insurable interest reduce moral hazard. If an insurable interest were not required, a dishonest person could purchase property insurance on someone else's property and then cause a loss to receive the proceeds. But if the insured stands to lose financially, nothing is gained by causing the loss. Thus, moral hazard is reduced. In life insurance contract, an insurable interest requirement reduces the incentive to murder the insured for the purpose of collecting the proceeds. Finally, the third purpose, an insurable interest measures the amount of the insured loss in property insurance. So, to be legally enforceable, all insurance contracts must be supported by an insurable interest. Property and casualty insurance at the time of the loss, life insurance only at the inception of the principle of subrogation. Definition: the principle of subrogation means substitution of the insurer in place of the insured for the purpose of claiming indemnity from a third party for a loss covered by insurance. In other words, the insurer is entitled to recover from a negligent third party any loss payments made to the insured. For example, suppose that a negligent motorist fails to stop at the red light and smashes into a car, causing a damage in the amount of $5,000. If the car's owner has an insurance on her car, his insurer will pay the physical damage loss to the car and then attempt to collect from the negligent motorist who caused the accident. Alternatively, the owner's car could attempt to collect directly from the negligent motorist for the damage to his car. Subrogation does not apply unless the insurer makes a loss payment, however, to the extent that a loss payment is made. The insured gives the insurer any legal rights to collect damages from the negligent third party. Purposes of subrogation. Subrogation has three basic purposes. First, subrogation prevents the insured from collecting twice from the same loss. In the absence of subrogation, the insured could collect from his or her insurer and from the person who caused the loss. The principle of indemnity would be violated because the insured would be profiting from a loss. Second, subrogation is used to hold the negligent person responsible for the loss. Finally, subrogation helps to hold down insurance rates. Subrogation recovers are reflected in the rate-making process, which tends to hold rates below where they would be in the absence of subrogation. Although insurers pay for the covered losses. Also, subrogation does not apply to life insurance contracts. This is like the principle of indemnity. Subrogation has relevance only for contracts of indemnity. Apply to property and casualty. The fourth principle and the final one, which is the principle of utmost good faith. Definition: an insurance contract is based on principle of utmost good faith. A higher degree of honesty is imposed on both parts to an insurance contract, and it is supported by representations, which are statements by the applicant for insurance. Number 2, concealments is intentional failure of the applicant for insurance to reveal a material fact to the insurer. It is the same thing as non-disclosure, that is, the applicant for insurance withholds material information from the insurer. And finally, a warranty, which is a statement that becomes part of the insurance contract and is guaranteed by the maker to be true in all aspects. And we have a comparison between the principles in terms of definition, purpose, and the area for application. Finally, the different multiple choice questions. Question number 1. Fundamental purpose of the principle of indemnity includes the following: I, to reduce physical hazards; I, to prevent insured from profiting from insurance. Choices: A, I only; B, I only; C, both I and I; D, neither I nor I, and the answer will be B, I only. The fundamental purpose of the principle of indemnity is to reduce moral hazard, not physical hazards. Number 2, the term replacement cost insurance, life insurance, valued policy loss means that it is a valued policy that pays a stated amount to the beneficiary upon the insured death, and this term is life insurance. Number 3, the principle of insurable interest, subrogation, indemnity, utmost good faith states that the insured must be in a position to lose financially if a covered loss occurs, and this is applied to principle A of insurable interest. Question number 4. The principle of means substitution of the insurer in place of the insured for the purpose of claiming indemnity from a third party for a loss covered by insurance. As we have mentioned before, this is principle of subrogation. Number 5,